Thank you, Daisy. Good afternoon and welcome, everyone. My name is Rich Woodbury with AFS Financial Solutions. We're pleased to have Tony Sondhi with us here today to discuss revenue recognition changes in upcoming exposure drafts. As many of you know Tony, he's president of AC Sondhi & Associates, member of the EITF, author, and professor. Today's agenda will include a brief overview of SOFTRAX solutions. And again, as I've mentioned, Tony is going to discuss some of the upcoming changes in the exposure draft, basic model and significant changes, impact on contracts and performance obligations, recognition and measurement principles, as well as some disclosure and application guidance. We will take questions via the live chat. Some brief housekeeping items. You can submit questions at any time through the Ask a Question feature located in the lower left corner of the webcast console. Your opinion counts, and your feedback is extremely important to us. There's a 1-minute feedback option at the conclusion of the webcast. Your browser will automatically be redirected to a short online survey. Presentation slides will be made available at the conclusion of the event, as well as a link to the on-demand recording of the webcast. CPE Credit is available to all attendees. You will receive your CPE certificate. You must submit the 1-minute web feedback questionnaire and check off CPE request box located at the top of the questionnaire. So first, let me begin with a brief introduction to SOFTRAX, and we'll turn the floor over to Tony. SOFTRAX is helping out hundreds of software firms, much like yourselves, gain better visibility into deferred revenue and billing so that they can manage their business. SOFTRAX automates the management of complex billing arrangements with your customers, from billing and operations to revenue and expense accounting to real-time visibility into your business. SOFTRAX provides independent order-to-revenue management and complex revenue recognition compliance, avoiding costly audits and restatements. We optimize all aspects of your customer billing and contractual arrangements, allowing you to introduce new and flexible business models, and most importantly, provide strategic revenue forecasting and analysis so that you can manage your business. As we all can agree, revenue recognition is becoming increasingly complex to manage. It is an extremely challenging area to provide and establish internal controls. Many existing ERP and financial applications do not automate this process, resulting in disconnected systems and pervasive use of manual spreadsheets. We can all agree that the compliance and restatement risk can provide much negativity to your business. Your close process delays and inaccurate revenue forecasting can be helped with automating revenue recognition management. SOFTRAX Operations helps you to manage and automate the ever-evolving accounting standards and compliance. It is important to recognize and understand that your order to revenue needs to be separate and distinct from order to cash. SOFTRAX Operations helps automate that order to revenue process. Establish a fair selling price for your contractual arrangements. Optimize fair value and selling price across multiple attributes. Provide revenue allocation to those elements. Allocate revenue using appropriate selling price. And ensure compliance against all regulatory standards, providing comprehensive audit documentation and recognition compliance, providing a flexible pricing and packaging while ensuring revenue accuracy. Certain governance, risk, and compliance considerations, certainly to manage revenue with a centralized auditable system that you don't get with spreadsheets. Standardize the compliance across multiple business units and geographies. Eliminate key audit concerns in terms of who made what changes and when. Provide comprehensive audit and documentation, reducing inconsistencies and risk of errors. Certainly providing immutable compliance with revenue recognition conditions. So with that, I'll turn the floor over to Tony. Tony?
Thank you, Rich. Let me just repeat a couple of the points that you've made. This is the first in a series of webcasts on this exposure draft, and we decided to offer more than one simply because of the complexity of the issues involved, and not to mention the fact that the boards are still working and making changes. So I'll take you through the changes in some of the issues that the boards have issued tentative decisions on through January. There are some new ones in February as well, and then they're meeting again this week to discuss a few other things. So the next webcast in this series is on the 26th of April, and we do hope that everyone who's here and a lot more people will come and join us on the 26th of April. And then, of course, we'll have at least one and maybe two more after the 26th of April because there's a series of these issues that we need to discuss. I also wanted to mention that as a member of an analyst committee working with the CFA Institute, I've been regularly meeting with the boards. We met in February with the FASB, and on April 5th, we're meeting with the IASB in London. And in both the meeting with the FASB and this upcoming meeting with the IASB, I will be leading the analyst discussion on revenue recognition. We're, of course, talking about a whole slew of issues, leasing, insurance, offsetting, hedging, and so on. And there will be other webcasts on those issues also. So just to mention that, please keep in mind, as Rich said, that CPE is available, but that also requires that you attend, the webcast. So you have to be here. And then, of course, as he said, fill in that point towards the end. Now, so what I want to do is today is going to be more of an introductory session. I do want to point out some very important issues, and then again, of course, if in a subsequent session I find that some changes have been made from what I said earlier or what I've discussed earlier, I will bring those back. So your questions are welcome. We will attempt to answer as many of them as we can towards the end of this webcast, before the end of this webcast, and then AFS provides me with all the questions that were sent, so I have the ones that I could not get to, and I will respond to those directly and send you a note with my thoughts on the question you've raised. And then, of course, the ones that are really good, we may incorporate those into subsequent webcasts to ensure that everybody gets the benefit of a really good question. So keep that in mind. Let me then begin with the issues at hand. So keeping in mind that we're talking about the revenue recognition exposure draft, you know that this has been around for a while now. As I pointed out, the boards have met regularly discussing this, and the staff has been working on the different issues. They've had a series of roundtables, and I encourage you to actually take a look at the roundtable slides. There are also archived roundtable meetings, and you will benefit greatly from that in the sense that you will be prepared. Now, the objective of this revenue recognition exposure draft is that the boards were interested in developing a single set of revenue recognition standards. Since majority of you are likely from the U.S., you're aware that U.S. GAAP contains a rather large number of revenue recognition standards. You also know that the EITF, of which I'm currently a member, continues to provide additional guidance and implementation, et cetera, on revenue recognition issues. For example, we recently issued the milestone method, and I notice among the audience we have quite a few people from biotech and healthcare companies which means that they would be affected potentially by the new EITF standard on the milestone method. For hospitals and so on, we've issued some other standards. So please keep those in mind. Now, as I said, we're starting with a single, where the objective is to create a single method of revenue recognition for all goods and services. It's a laudable goal. It makes sense rather than having it fragmented across a ton of different accounting standards. But it also means that it's very difficult to do. Now, as I said, the objective to create a single standard comes from the fact that existing U.S. GAAP has too many rules. There's a lot of industry-specific guidance, and obviously, as a result, a fair amount of conflicting guidance. The IFRS, on the other hand, has the opposite. They have a few general principles in one general revenue recognition standard, and then another standard on contract accounting. And then, of course, they have very little, if any, implementation guidance. But I've heard that the IFRS, the IASB, is revamping their IFRIC, which is their equivalent of the EITF, and one hopes that that will produce a significant amount of implementation guidance going forward. Now, as you can see, one of the reasons for doing this is that there's a fair amount of U.S. GAAP guidance, and a lot of that, effectively, has to do or results in a great deal of subjectivity. So one sort of overarching principle or lens through which I view this exposure draft is to ask myself, have they reduced the subjectivity? And so far I can tell you that I don't believe it. I don't see it as reducing the subjectivity. I think this standard introduces far more subjectivity than we had. So it's not clear to me that that's an improvement. Now let's take a look at the scope. Remember, as I said, it's supposed to be a single standard, but we begin with scope exceptions. The scope exceptions, for example, executory contracts. Now, both boards for a very long time have stayed away from executory contracts. They have proposed a new standard on leasing. It's, what's interesting is that leases are fundamentally executory contracts. So if that's the case, and we can have a standard on leasing, why don't we have a standard that encompasses other executory contracts? Insurance accounting does have things in common with revenue recognition, and yet there's a separate project on insurance accounting, and there are some cross-cutting issues that I think are critical, and that the boards ought to do something about those issues as well. Mining, biological and agricultural assets, financial instruments. I think that it would be useful to have accounting standards, obviously, for these as well, and it would make sense for them to fall under the same umbrella, but they don't at the moment. There isn't, again, the issues with, for example, there's the lessor accounting issue. Now, lessor accounting, you should take a look at the exposure draft that's out there, because lessor accounting is fundamentally revenue recognition. The really critical thing with lessor accounting that I think you ought to keep an eye on is very simply this. There are transactions that many of you engage in that are actually a combination. There are multiple element arrangements. There's a lease or one or more leases in it, as well as services. What you have to do is try to segment the services, separate them from leasing. For the service component, you would use revenue recognition guidance. For the lease component, you would use lease accounting guidance. So that's an area that many lessor accounting issues will then have something to do and will have to reach into the revenue recognition guidance in order to develop their accounting appropriately for it. So please keep that in mind. And those of you who are engaged in activities as lessors, you may want to keep an eye open for some of my webcasts on lease accounting as well. Then what I wanted to do was to spend a little bit of time talking about the core principle, which is, again, really very good. It's exactly what it should be. Whether it actually achieves this is something we're going to have to wait and see. So the principle is that the amount of revenue recognized needs to reflect the consideration that the entity has either received or it expects to receive in exchange for goods and services that have been transferred to the customer. Now, observe carefully some of the issues in here. Excuse me. Note that it says consideration that the entity receives or it expects to receive in exchange for the goods and services transferred. So the first part is the amount of the consideration received or expected to be received, which means the accounting for collectability of the amount charged to the customer becomes an important consideration. The second issue then is, consider the issue of transfers, right? So what about the goods and services transferred to the customer? So the issue of the transfer itself is something that we will have to be concerned about. I do have a few comments on that in my materials here, and we'll be discussing that again in one of the future webcasts. Okay. Now, what's the basic model? It requires that you identify the contract or contracts with the customer. Second, once you've identified the contracts, you will then identify all of the separate performance obligations in that contract. Once you've done that, you will determine the transaction price, and then the critical component next is the allocation of that transaction price. Now, please keep in mind that once you've allocated the transaction price to each of the separately identified performance obligations, that's when you would recognize revenue for those performance obligations as they're satisfied. And therefore, the allocation is a critical component. The determination of the transaction price is an important consideration, as is the identification of the separate obligations. Now, let's then look at some individual considerations within these broad issues that we have to deal with. And please keep in mind, as I said earlier, I'm not going to deal with all of them today because I want to lay this sort of foundation, sort of a groundwork for the work for one's understanding of this exposure draft. Now, please keep in mind that I am not here today going to discuss anything about transition. We're not going to get to disclosure yet. We will take a look at each one of these in detail. However, we need to set the basis first. So in a sense, as I always do in my seminars and my other webcasts, I'm going to begin with the fundamentals. In other words, we're going into the basic building blocks of this new alphabet that we're going to have with respect to revenue recognition. My first issue, the contract with the customer. In a sense, this is similar to the requirement today that in order to recognize revenue, you have persuasive evidence of an arrangement with the customer. Previously, what we said was that that persuasive evidence of an arrangement would spell out the rights and obligations of both the seller and the buyer. So that's what we're looking at here. So the first issue that comes up is, should we be focusing only on legal obligations? Or do we take the concept of substance over form and also apply it here? In other words, do we also need to consider constructive obligations? So that's one of the things to keep in mind. I will come back to this in just a bit. The second question that I think is critical is, under what circumstances do you need to combine two or more contracts? Now, there's a difference of opinion about that. The U.S. has standards on linkage. Some of them come from implementation guidance, such as technical practice aids for software revenue recognition. Some of the standards that we have come very simply from different accounting standards, such as the contract accounting standard, which actually spells out in a rather detailed fashion the criteria that you have to satisfy in order to combine two or more contracts, or as well as the criteria that you need to satisfy in order to segment a single contract into two or more contracts. So these are issues that we do today, we work with today. Now, let's see how we deal with them here. Identification of the separate performance obligations. Note that's our second issue. Again, this is similar. In a sense, what we have here is that performance obligations need to have a distinct function and profit margins. To a large extent, the concept of distinct function and profit margins, at least in concept, is similar to the existing standalone value principle that we have in multiple element transactions, and we've had for some time in the U.S. in EITF 0021, and now in EITF 081, where it becomes even more significant. Oh, I just realized I'm using old classification schemes, not talking about the codification paragraph numbers. I decided we'd be better off without my reeling off that list of 10 or 12 digits that you have to know in order to figure out which issue I'm talking about. On the other hand, of course, it's always possible to come up with those fairly easily, and you are going to have to get used to it. But more importantly, with respect to the identification of the separate performance obligations, I think is another issue. Once we've identified those separate performance obligations, is that going to affect the timing of revenue recognition? Now, from what I've seen and the analysis that I've done and what I've been looking at or working on with some of my clients, as well as in the seminars that I've offered on this topic, my conclusion is that EITF 081 relative to EITF 021 resulted in effectively an acceleration of the amount and timing of revenue recognition. In other words, there's a lot less deferred revenue today than we used to have under 0021, which is, of course, one of the objectives. What's interesting is that this proposed standard, this exposure draft, I think further accelerates the amount and timing of revenue recognition. In other words, I am significantly concerned with the fact that this accounting standard will result in a significant amount of front-loading of revenues. And I think that's a problem. That to me is not a characteristic of a better standard. But I think there's going to be a lot more front-loading here. The other issue is that there will be far more new products and future products and services that will be included in contracts because of the way we identify the obligations, because of the way we separate them, and because of the allocation of the arrangement consideration. More on that, of course, later. Now, as I said, another principle is the transaction price. This proposed standard, the exposure draft, talks about the determination of the transaction price using the contractual terms, as well as it requires a focus on customary practice. So you're going to use both. Two more points to keep in mind. There is a requirement, in a sense, for reasonable estimation using relevant experience. So it will be vendor-specific customer experience in a way, just to use the terminology that most of us are comfortable with at this point. Or maybe I shouldn't say comfortable, because I know a lot of people are not comfortable and don't particularly like VSO requirements. Another issue that we have to keep in mind is here we will increase the reliance on management estimates of selling price with less and less reference to market data. I know there's language in there that seems to suggest that, but I think that the amount of reference we have to market data has been reduced substantially. In other words, what we're going to do is rely much more on management estimates. And that, again, will contribute, I think, to the changes in the amount and timing of revenue recognition. The next point, of course, in terms of broad principles, is the allocation of the transaction price. Now, the amount of the transaction price, then, the best evidence for each performance obligation, or the best evidence of the transaction price that should be attached to each performance obligation, is to be based on observable separate transactions of that same performance obligation, or in that same performance obligation. Of course, where you don't have observable separate transactions, you will end up using an estimate of selling price. So which, by the way, as you can see, if you were talking about new products, you wouldn't have observed separate transactions, and therefore you must use an estimate of the selling price. And for that reason, again, as I said earlier, there will be an acceleration of the amount and timing of revenue recognition. Of course, the fundamental question is it an acceleration of amount and timing given, or does that acceleration appropriately reflect the way in which that entity becomes entitled to the arrangement consideration? And I think there again we'll have to see if we have actually achieved a better result. As I said before, I'm not yet convinced that we have a better result. Again, as I said, please keep in mind, you're going to use an estimate where you don't have separate transaction data. Even more important, it's going to be a management estimate without a huge or a significant reference to market data. Now let's take a look at the next issue, which is the satisfaction of the performance obligation. Here is where the transfer principle comes in. A vendor is said to have satisfied a performance obligation when a product or a service, a good or a service, is transferred to a customer. What does that mean? In essence, this exposure draft tells us that a successful transfer means, or a completed transfer means, that the customer has control of that good or service. So what is the meaning of control? Now, the control principle that the boards are working with at the moment is that the customer should be able to direct the use of and benefit from, in other words, the cash flows that result from that good or service, which of course also means that it prevents other entities from directing the use of and benefiting from the good or service. Now, this is where there might be some interesting issues with respect to intangibles, because it is possible, of course, as you know, for an intangible asset to be used by more than one entity at the same point in time, and for more than one entity to benefit from the cash flows that will result from that particular good or service. Now, there is another thing that I think that's very important with respect to the control principle, and I'd like you to take a look at it here. The final standard, the boards have decided in January 2011 that the final standard will describe rather than define control. So notice that they've decided to stay away from actually defining control. In one sense, you could say that they're doing what they did with consolidation, they're doing what they did with variable interest entities, and so on. But at the same time, there are effectively two ways of thinking about control. Now, one of the things the boards have decided in January of this year is that the risks and rewards of ownership should be another indicator in determining whether control has been transferred. Now, please keep in mind, as I note here, that lessor revenue recognition also contains a control principle. Now, in fact, it's as a consequence of the lessor accounting exposure draft, or the lessor accounting component of that leases exposure draft, the way in which we look at control in the lessor standard, effectively, I think what's going to happen is that we have a slightly different slightly different meaning of control in lessor accounting. So if they're not identical, and lessor accounting is in essence, it is in essence revenue recognition, then the fact that we have two different definitions, or potentially different definitions, suggests to me that there will be some conflict. And I think it's important that the boards resolve that. Okay. Then some additional information about the satisfaction of performance obligations. Some indicators. Unconditional payment obligation. Title transfer has occurred. Customer has physical possession of the good. Design or function of that particular good or service could be customer specific. So these are some of the indicators that will suggest when you've satisfied performance obligation. Once again, more on this in a subsequent webcast. Excuse me. The next point I want to make is the contentious issue of the continuous transfer of goods and services. It's possible that you will be able to use output methods, input methods, or the passage of time. The last one, of course, the passage of time, would effectively result in ratable revenue recognition. Now, again, it's possible that there won't be too many issues, but at the same time, I think that we need to understand that a little bit better. So it would be helpful if there were more examples explaining this concept. Once again, we'll explore this further in a subsequent webcast. For products and services, some of the other tentative decisions. The first thing is that there will be a discrete versus a continuous revenue recognition model. Now, a single performance obligation that has both products and services should be treated as a service. So this is an issue where, what's interesting is what it means is that you had an obligation to deliver a product and provide a service, but for various reasons, you have to treat it as a single performance obligation. The boards have issued some indicator in January 2011, some indicators that a performance obligation actually is a service. The customer controls the work in process. Tasks already completed do not need to be performed over again in order to fulfill the remaining performance obligations. In other words, there is some separation that's possible there. Another issue is unconditional obligation to pay, and then performance to date has no alternative use to the customer. Now, these are, of course, a little bit different, and it'll be important to get a good sense of this and start thinking about examples and where these indicators work. Progress towards completion may be measured using input, output, or even the passage of time. But it's going to be important that the vendor be able to develop a reasonable estimate of the progress towards completion. Linkage. Now, remember I had started this whole discussion off, and one of my earliest comments was, when do you have to combine two or more contracts? Now, linkage has been, as I pointed out, a rather significant component of our accounting standards in the U.S. There's a Technical Practice 8, 5139, that governs linkage in the case of software revenue recognition. The contract accounting standard has a significant amount of detail with respect to when you should link two or more contracts, and it similarly has a lot of information about the conditions under which you're permitted to segment a contract into two or more contracts. Now, what the tentative, there's an interesting decision in January. The boards have decided to eliminate the requirement to segment a contract into two or more contracts. So the linkage remains, but the segmentation goes away. In other words, the only condition under which you will separate a contract into two or more performance obligations is if you can identify those performance obligations. Of course, then the question is, what is required for us to effectively identify the performance obligations? Here, the boards have introduced the concept of distinct performance obligations. The attributes are that the two or more performance obligations have a distinct function. You can separate the risks involved. And there's a different pattern of transfer of control to the customer with respect to those. So these are quite different in a sense, these distinct concepts than what we've had before. The board has decided that they will not provide guidance in the final standard on perfunctory incidental performance obligations. And they will not provide additional guidance on marketing incentives either, discounts, and so on. There are, however, some interesting changes as well with respect to product warranties. And actually, one of the most interesting things is that vendors will be required to recognize revenue and accrue costs related to quality assurance. Now, what's interesting is that if a latent defect existed upon transfer of the good or service to the customer, you normally, instead of deferring revenue, what you'll be required to do is recognize revenue and accrue costs. Now, please keep in mind, the operative term here is latent, okay? So that's one of the things that we have to keep in mind. The other point is that a warranty, however, is considered a separate performance obligation if one of two conditions is satisfied. If the customer has an option to purchase that particular warranty separately. In other words, we're talking about the concept of an extended warranty arrangement or product maintenance arrangements. If the warranty provides a service beyond quality assurance as it is contractually specified, then that warranty would be treated as a separate performance obligation. This is welcome clarity. These concepts, in a sense, exist in practice, but to have them spelled out here is certainly, in principle, it's a good thing. Okay? Then, cost recognition. Now, this is something that's always been difficult simply because there's not much guidance on cost recognition, or cost deferral even more so. Here, vendors are required to capitalize incremental direct costs of obtaining a contract if they can demonstrate that they expect to recover it. Now, this is not very different from what we've had, in a sense, in practice. Recognition would have to be systematic and then reflects the pattern of transfer of the performance obligation to which those particular costs relate. So as I said, there is here some additional information with respect to cost recognition, which is welcome. Then the next thing that I want to talk about a little bit is just a series of some questions. And, in a sense, hopefully you already have these based on what I've been saying so far. As I said earlier, should we limit ourselves to legal obligations, or should we also consider the constructive obligations? And I think if you take the concept of substance over form, then to me at least, it makes a lot of sense to consider both constructive and legal obligations. And I think that it would be good if the boards were to be very clear that both are included. There is some confusion as to that. Identification of separate performance obligations. Does standalone value for delivered performance obligations remain a requirement under the exposure draft and multiple element transactions? Well, what's interesting is that instead of the standalone value, we've moved to the concept of a distinct obligation. To some extent, it sounds similar, but I think we'll need to have to at least think a little bit more about this in order to understand whether there are conditions in which we will have a concept that's very different from standalone value. Now, standalone value in practice certainly is variably accounted for today in U.S. GAAP and under international accounting standards. So it'll be good to see that there's something in here, a principle in here, that may guide us to less variability with respect to that. Now, don't get me wrong, if the economic substance of the contract suggests variability, then I would be fine with that. Satisfaction of performance obligations. Is control or the transfer of control a qualitative assessment, or is it a quantitative assessment? And if it is, then is there going to be, if it's a quantitative assessment, will there be a bright line? And I hope not, because bright lines effectively only do one thing. They help people to figure out which side they want to be on, right? So in that sense, a principle would be better, and if it's qualitative and subjective, that's fine. There's a lot of judgment in accounting. I don't see why there shouldn't be judgment in revenue recognition. It's necessary. The last two questions that I have deal with the transaction price. So there the issue is, What if a company, a vendor, cannot develop a reasonable estimate of the transaction price? And this will happen in some cases with transactions or arrangements, contracts that contain software, intellectual property, certain kinds of lease transactions, and just as importantly, new and future products. So what is currently in your roadmap, what happens when you include it in a contract? And if you have to include it, or if you've decided, to include it, then how do you come up with an estimate? And if you cannot develop a reasonable estimate, then how is that going to affect the amount and timing of revenue recognition? Now, once again, please note that I had said earlier that the boards will discuss transaction price and some of the issues related to transaction price this week. And so we'll see what happens. I'll review what they've come up with. And then, as I said, I have the meeting with the IASB on the 5th of April where we'll have further discussions. And hopefully that'll help understand these issues better, because I'm certainly going to ask some of these questions to the board as well. And then, effectively, what that'll do is help us do an even better April 26th, which is the next webcast in this series. The next point is the allocation of the transaction price. Observable transactions are required to establish a selling price, and only when you don't have those did you use an estimate. So the question is, how many observable transactions do we need? By the way, I hope nobody's really concerned about that, because I may have stolen your thunder by asking that question myself. But I understand that's a relevant issue. So those are my remarks. What I do want to do is spend just a couple minutes showing you some of these. I have a series of seminars coming up, EITF 081 and 093 in April. There are, of course, the advanced topics in software revenue recognition. And I will also be offering in the month of May a session on advanced topics in general revenue recognition. So please keep an eye open, or just go to my website. Call me at this number if you want to know more about the agenda for any of these or any of the other topics that I just mentioned. And finally then, the last set, the software revenue recognition sessions that are coming up, one each on the East and the West Coast. And then, of course, new one that I've just added on leasing, a one-day session on lessees and one on lessors, so you can attend whichever one applies to you. And then, of course, a half-day session on this exposure draft, far more comprehensive, of course, than I can do justice to in about 35, 40 minutes here. But, of course, with the series, we'll have much more time. And then, lastly, the general rev rec classes that are coming up. So with material on the exposure draft and a little bit of advertising thrown in there, Rich, it's all yours if you would ask me questions.
Great. Thank you, Tony. We've got a number of questions here, so let's get to a few of these, folks. And those that we do not get to, we have these captured along with who posted the question, and we'll make sure that we get you an answer following the event. First question, Tony. Is software as a service a continuous obligation?
Generally speaking, software as a service would meet the definition of a continuous obligation, yes, a continuing obligation, correct.
Okay, super. The next question. Do you expect the final standard to be issued by June 2011, or do you anticipate that the issuance of a final standard will be issued subsequent to this date?
Well, I guess, Rich, I was just thinking that maybe with the previous question, I was so definitive that somebody would ask me those kinds of questions. This one's not quite that category.
Yeah,
it's a little difficult. Let me give you the following. And please keep in mind that obviously, there's no way for me to tell what's going to happen. As a friend of mine likes to say, forecasting is pretty difficult, and forecasting the future is just much, much more so. Now, here's the thing. The standard does have some obvious questions. The boards are working, the staffs are working on these, and I know that they're doing a great job with them. The problem is that it's unclear right now whether they're going to be able to resolve these. The changes that they've issued in January and February are pretty significant. This week when they meet, there might be even more significant changes. So then the question becomes, given that there are so many changes in the last few months preceding the announcement of the standard, and when you add to that, the fundamental issue that there are still so many different transactions that are excluded from the scope, which I pointed out earlier, it's not clear to me that they will be ready. On the other hand, the boards are resolute. Every conversation that I've heard of or had with them or anything that I've seen written suggests to me that they are certainly interested in and will most likely want to finish it by the 30th of June. Another issue is that there will be a significant turnover on the IASB. I know we've had 2 new people added to the FASB as well, but at the same time, the IASB is going to have a significantly greater number of new people, and those people come in after June 30th. So from that perspective, I think they really do want to finish it by the 30th of June, but does that leave a lot of questions unanswered on the 30th of June? It's possible. So we'll have to wait and see. If I had to make a decision or take a wild guess, or maybe an informed guess, I should say, I'd say that they will likely go ahead on June 30th. Then the question will become how long a transition period, and in other words, is the transition period sort of a field test? Do you go out there, try it out for 2-3 years and see what it feels like, and then make adjustments? So those are some of the issues. Hard to say, though.
Regarding control, what about software that is time limited with code that renders the software disabled when the time period allowed expires?
Well, one way to look at that is that you have transferred the use for a term, for some period of time. It's only after that that the self-destruct or whatever that code is which prevents you from using it kicks in. So in that sense, yes, you have transferred it for some period of time. One way to think of that is the continuous transfer argument that we talked about earlier, but for a limited period of time. So from that perspective, I think transfer of control with respect to that particular scenario doesn't present necessarily a host of insurmountable problems. Might have a little bit of work to do on the specifics and the implementation, but it's not that difficult to say that control does get transferred, albeit for a short period of time or a specified period of time.
All right, next question. Will the allocation among deliverables apply to U.S. government cost plus fixed fee development contracts, in parentheses, where recognition today occurs monthly upon billing?
Well, to me, there is nothing in the document that suggests that a specific class of contracts will be exempt, that particular class. There's nothing in there that suggests that. Having said that, in a sense, it's quite similar to contract accounting, unless I misunderstood that. There, it seems to me that there will be some change. What you'd have to be able to demonstrate is that the amount that you're recognizing at the end of the month and that you billed for, you actually have achieved a certain, you've transferred something, and you can measure the percentage of work that you've completed. And then there are some other criteria for the application of that continuous transfer or a transfer over time. And some of that may be revised in the March meeting or a subsequent meeting, say April or May. We'll just have to wait and see. But strictly speaking, I don't see any exemptions in there yet for that particular class of transactions.
Okay. Let's take 2 more questions, I guess. Is a look-back analysis necessary to justify management estimates with actual market data?
Well, right now, the emphasis is actually on management estimates. To some extent, market sort of conditions will influence the estimate. I think that using a look-back approach, developing a sort of a VSOE type of approach for the estimated selling price is perfectly reasonable, and in fact might give management in particular, might give the members of the audit committee and the senior management more comfort in that estimate. Because, see, the fundamental point with the estimates is not whether they allow you to recognize revenue today or whether they change the amount of deferred revenue or not. What really matters is how good an indicator is it of your ability to continue to generate that much revenue on that schedule in the future. So the basic point about estimation or any number that you use in financial statements is how informative is it? What does it tell you about tomorrow? If you come up with a number, an estimate, or even a VSO, fair value, as that concept is used in software revenue recognition today, but if that does not reflect what's going to happen in the market tomorrow or in the next month or so, then that price that you've come up with and that you use to allocate the arrangement consideration and then ultimately use to determine how much you can recognize today, how much you're going to have to defer, all of those, right? If it doesn't provide information about the future, it's not very helpful. So from that perspective, the more information that you use as a basis for developing a reliable number, in other words, reliable in the sense that it's a good indicator of how much money you would make if you sold, for example, the same number of units the next year, did the same amount of service, or maybe some multiple thereof, or some incremental amount. So the point is that the more documentation you have, the more carefully you can justify these prices, the better off you're going to be, the better for even internal purposes will your amount of revenue recognized and the amount that you've deferred be.
Okay, we're at 155. How would you treat software arrangements with rights of exchange for unspecified software products?
Well, I guess the question is not about what we do today. The question is about what's going to happen under this exposure draft. And under this exposure draft, what you will do is develop an estimated selling price for those unspecified future products, which, of course, when you think about that answer, you say to yourself, well, how am I supposed to come up with an estimated selling price of something I haven't done yet? But that's my question as well. So my concern with this, the ability to use estimated selling prices under any circumstances, is that there will be cases where I don't have a basis for developing an estimated selling price. Now, in this particular case, since we're talking about unspecified future products, the first thing you would do is ask yourself, how different are these future products supposed to be? Right? Are they similar to what I have right now? Do they add additional features, functionality? Is there something else that they can do that the products are not doing today? So you want to try and find comparable products within your company and then determine how much of a difference is there in this unspecified. In the future, when you deliver that product, is it going to have features, functionality, et cetera, that are significantly beyond what you're doing today, or are there going to be one or two things that are going to be different? Those are the ones that it becomes really difficult to come up with an estimated selling price. And I think what will happen is it becomes difficult for, as I said, intellectual property. It becomes difficult for certain lease transactions, and it's difficult for unspecified, future products and services.
Time for one more, Tony?
Sure.
Does a formal customer acceptance come into play for revenue recognition?
Strictly speaking, I would say that a formal acceptance is no longer in play the way I read this. The satisfaction of performance obligations is indicated by other characteristics more so than a formal acceptance. But again, as I said, you have to stay tuned to this one because they're still trying to figure out a whole bunch of stuff with respect to it. But right now, my initial thought is that it won't be. The formal acceptance won't be an issue. Which, obviously as the question in a sense suggests, that would be quite a departure from where we are today.
All right, super. Thank you, Tony. Certainly thank you, ladies and gentlemen, for joining us here today. Please keep in mind that the presentation will be made available to you as well as the presentation materials in an on-demand recording of this event via email as well as via revenuerecognition.com. Also, please look for details for the next event in this series on April 26th, which will include updates to many of today's topics. Again, thank you, everyone, and enjoy the rest of your day.
Thank you, Rich. Take care.
Ladies and gentlemen, that does conclude the conference call for today. We thank you for your participation and ask that you please disconnect your line.